from the financial center of the world's #1 economy, perhaps soon #2. According to the IMF, China is going to take over very soon, and that's because the country has its own problems. I'm here now standing in front of Trump building, one of the many buildings that the President of the United States has around New York. He bought it for $1 million in 1995. Now it's worth $600 million. Suddenly, similar fortunes have been made around this area, and very especially just behind of where I am now, the New York Stock Exchange, and very especially since 2008 and 2009, when central banks around the world and the Federal Reserve flooded the market with billions of dollars of money buying assets. But this is changing now. We're moving from quantitative easing into quantitative tightening, and very recently we had a market sell-off. Both bonds and stocks fell into October fashion. The person who now occupies the White House says that there's somebody very responsible and who's led and helped create that market sell-off. It's no other than the Federal Reserve, whose powerful New York base I'm standing here right in front of on Liberty Street in the heart of the financial district as well. According to Trump, the Fed is out of control because they're raising rates too quickly, and that could hurt the economy and, for example, lead to the help cause the recent market sell-off that we've seen. Of course, many people have come out in defense of the Fed, including the IMF, that from its meeting in Indonesia had just said that the Fed hikes are perfectly legitimate. Who's right? Let's see what economic theory says. According to common thought, long-term rates should equal nominal growth. On that account, if we have inflation at about 2% and we add real growth, that should give us a rate much higher than the present federal funds rate. But does the Fed really hike rates? Short-term rates, yes, but long-term rates, not really. The market does. People do. So let's see what the US economy looks like. Unemployment is at record lows. Wages are rising. Gross domestic product is increasing at a healthy pace. All this optimism has lifted long yields in a moment called by some, for example, M&G fund manager Richard Woolnough described it as the anaconda moment, as if the dormant snake that has been flat for years is now finally waking up. The Fed is also very bullish, as we can see in the projections, known as its dot plot. So enough people in the markets, as we see, have a different view. The line is a lot lower. Why? The IMF is the first to warn that global trade, because of all the challenges and the trade war between the US and China, that could hurt trade. Oil prices are also going up. And according to M&G fund manager Jim Lewis, this could also dent growth. Corporate profits are increasing, but some people say this is a sugar high just created by the tax cuts. The cycle is long and could be also giving some signs of exhaustion. And there's turbulence in emerging markets, especially in Argentina and Turkey and Pakistan as well. Where does this all leave us? Maybe this is time for pause and consider everything that's happening. We have the end of QE, we have China growth, we have even the status of the dollar as the world's reserve currency being challenged. Usually the price that countries pay to hold the world's reserve currency is a large current account deficit. But now the US doesn't want to have deficits anymore. In Europe we have Italy, we have Brexit, and usually even the rock-solid German industry, instead of having an Oktoberfest, seems to be having an October rest. Maybe the only thing that's not going to change is change itself. And as a matter of fact, where I'm here now in front still of the New York Stock Exchange, the tree that this tree is trying to replicate was a much bigger tree under which in 1792 22 stockbrokers met to establish some good rules for the very incipient but successful stock and bond market. Trading has not stopped ever since and probably won't. And this is why there will still be more opportunities for those who can read and interpret markets well, and also who have the flexibility to implement the views. If you want to see some examples on our blog, you can read why Jim Lewis thinks that perhaps this is now a time to be more cautious, while Richard Woolnough thinks that there's plenty of these companies traded here who can still offer good income and dividends. Claudia Kalic says that despite all the turbulence in emerging markets, some of them have done their homework well and can still deliver good results. And you can see many other examples from Jane Tomlins, from Ben Lord. Enjoy the reading and stay with us. For the moment, that's all from New York.